S. Differentiate between temporary differences and permanent differences, and identify examples of each. Temporary differences arise when book and tax recognition timing differs but eventually reverses. These differences create deferred tax assets or liabilities because the related amounts will affect taxable income in future periods. Examples include differences in depreciation methods, installment sales for tax purposes, prepaid expenses, accrued expenses, and estimated warranty costs. Temporary differences are the foundation of deferred tax accounting. Permanent differences affect only one reporting system and never reverse. They arise when certain revenues or expenses are recognized for accounting purposes but never for tax, or vice versa. Examples include tax-exempt municipal bond interest, included in book income but excluded from taxable income, and fines or penalties, deductible for book but not for tax. Permanent differences do not create deferred taxes. Understanding the distinction is critical for accurate tax reporting. Temporary differences impact both the balance sheet, through deferred taxes, and the income statement over time. Permanent differences affect the effective tax rate but do not result in deferred tax assets or liabilities. Proper classification ensures correct measurement of income tax expense and future tax consequences. T. Distinguish between operating and finance leases. A finance lease transfers control of the underlying asset to the lessee. Under U.S. GAAP, a lease is classified as finance if it effectively transfers ownership, contains a bargain purchase option, covers a major part of the asset's economic life, has lease payments equal to substantially all of the asset's fair value, or the asset is specialized. Finance leases reflect asset acquisition with long-term financing characteristics. An operating lease does not transfer significant ownership risks and benefits. If none of the finance lease criteria are met, the lease is classified as operating. The lessee obtains the right to use the asset without assuming substantial ownership characteristics. Although both lease types recognize a right of use, ROU, asset and lease liability, expense recognition patterns differ. Expense recognition differs between lease types. Finance leases recognize separate interest expense on the lease liability and amortization expense on the ROU asset, resulting in higher total expense in early years. Operating leases recognize a single straight-line lease expense over the lease term, producing even expense recognition across periods. U. Recognize the correct financial statement presentation of operating and finance leases. Both lease types recognize a right-of-use asset and lease liability on the balance sheet. At commencement, the lessee records the present value of lease payments as a liability and an equivalent ROU asset, adjusted for initial direct costs and incentives. Lease liabilities are split between current and non-current portions, affecting leverage and liquidity ratios. Income statement presentation differs by classification. For finance leases, amortization expense is included with depreciation and interest expense is reported separately, typically below operating income. For operating leases, a single lease expense is reported within operating expenses. This difference affects operating income and EBITDA comparisons. Statement of cash flows classification varies. For finance leases, the principal portion of payments is reported as a financing outflow, while interest is classified as operating under U.S. GAAP. For operating leases, total lease payments are operating cash outflows. Thus, finance leases generally increase operating cash flow compared to operating leases, improving certain performance metrics. 5. Identify transactions that affect paid-in capital and those that affect retained earnings. Paid-in capital, contributed capital, is affected by owner investment transactions. Issuance of common or preferred stock increases common stock and additional paid-in capital, APIC. When shares are issued above par value, the excess is credited to APIC. Repurchase of treasury stock reduces total equity. Reissuance of treasury shares above cost increases APIC, while reissuance below cost may reduce APIC from treasury stock transactions. Retained earnings are affected by income-related and distribution transactions. Net income increases retained earnings, while net loss decreases it. Cash dividends and property dividends reduce retained earnings when declared. Prior period adjustments, such as correction of material errors, also adjust beginning retained earnings. These transactions reflect accumulated undistributed earnings rather than owner contributions. Some transactions affect both paid-in capital and retained earnings. Stock dividends transfer amounts from retained earnings to contributed capital. Small stock dividends are recorded at market value, increasing common stock and APIC while reducing retained earnings. Large stock dividends are recorded at par value. These reclassifications do not change total equity but alter its composition. X. Apply revenue recognition principles to various types of transactions. Revenue is recognized when control of goods or services transfers to the customer. Under U.S. GAAP, recognition is based on transfer of control rather than transfer of risks and rewards alone. Control may transfer at a point in time, e.g., retail sale, or over time, e.g., long-term construction contract. Proper identification of performance obligations ensures revenue reflects actual delivery of promised goods or services. Different transaction types require tailored application of the standard. For long-term contracts satisfied over time, revenue is recognized based on progress toward completion, often using cost-to-cost measures. For bundled arrangements, multiple-element contracts, total transaction price must be allocated to distinct performance obligations based on standalone selling prices. This prevents premature or excessive revenue recognition. Variable consideration and contract modifications require careful estimation. Discounts, rebates, performance bonuses, and returns must be estimated using either expected value or most likely amount, constrained to avoid significant reversals. Changes in contract scope or price may create new contracts or modify existing ones. These estimates affect both revenue and related assets or liabilities. Y. Demonstrate understanding of revenue recognition using the required 5-step model. Step 1. Identify the contract with a customer. A contract exists when there is approval, clear rights and payment terms, commercial substance, and probable collection. Without enforceable rights and obligations, revenue cannot be recognized. This step ensures the transaction qualifies under the standard. Steps 2 and 3. Identify performance obligations and determine transaction price. Performance obligations are distinct goods or services promised to the customer. The transaction price includes fixed and variable consideration, adjusted for time value of money if significant financing exists. Proper identification ensures accurate allocation of revenue. Steps 4 and 5. Allocate transaction price and recognize revenue. The total price is allocated to each performance obligation based on standalone selling prices. Revenue is recognized when, or as, each obligation is satisfied, either over time or at a point in time. This systematic approach ensures consistency, comparability, and faithful representation. W. Determine the effect on shareholders' equity of large and small stock dividends and stock splits. Small stock dividends, typically less than 20% to 25%, are recorded at market value. Retained earnings is reduced by the fair value of shares issued, while common stock, at par, and APIC increase. Total shareholders' equity remains unchanged because the transaction represents a reclassification within equity. However, retained earnings decreases significantly relative to par value. Large stock dividends, greater than 20% to 25%, are recorded at par value. Retained earnings is reduced only by the par value of shares issued, and common stock increases by the same amount. APIC is not affected beyond par. As with small stock dividends, total equity does not change, but the composition shifts toward contributed capital. Stock splits do not affect total equity or retained earnings. Instead, the number of shares outstanding increases while par value per share decreases proportionately. No journal entry is typically required, only memorandum disclosure. Stock splits reduce market price per share and improve share liquidity without altering total shareholders' equity or overall ownership percentages.